and good morning to our friends and colleagues in the United States. Happy 2021. My name is Simon Weintraub, and I am a partner in the high-tech department of Yigal Arnon. I am here today with two of my colleagues, Nimrod Vroman, who is a partner in the high-tech department, but also the founder and CEO of Consigliere, a high-tech consulting boutique. Nimrod has extensive experience working with entrepreneurs from the early stages and guiding them through their development all the way to exit. Nimrod has founded two successful companies in the high-tech services space, Y-Tech Runway and Consigliere. In addition, I'm here with my partner, Adrian Daniels from our capital markets group. Adrian, among other expertise, has been representing publicly traded Israeli technology companies for many years. He is a great resource for Israeli companies that need to be guided through the complex world of the US securities laws. We are hosting this event today with our good friends at Moelis & Company. Moelis is a global investment bank and has recently doubled down in Israel by hiring our close friend, Ilan Zivotofsky, to serve as managing director and head of Israeli operations. We at YA have known Ilan for a long time, have worked closely with him both at our crowd and also at IBEX Partners. We wish Ilan much success in his new role and look forward to hearing from Ilan as well as from his US-based partners, Jared Dermott and Alan Aberg. Mr. Ken Moelis is also in attendance and will be addressing us today. I think it's no coincidence that the first webinar that YA is hosting in 2021 is focused on SPAC offerings in the US. For those of you who are unfamiliar with a SPAC, think of it as a reverse process of a typical IPO. And a SPAC company first raises money from investors, becomes publicly traded, and then uses this money to purchase a target company, usually in a particular sector, within a certain period of time. In 2020, approximately 250 SPAC companies were listed, more than half of the overall listings in the US, raising about $81 billion, 6 times the amount raised in 2019. Here in Israel, just this past month, Israeli autonomous car technology company Innowiz merged with a SPAC at a reported $1.4 billion valuation. It has been reported that several other Israeli companies have been looking to do similar transactions, including Taboola, Monday.com, IronSource, and eToro. Why is this happening now? As far as I know, SPACs have been around since the early 2000s. Let's ask the experts participating on today's webinar, but here are some of my preliminary insights. M&A exit transactions in Israel were significantly down in 2020, down to about $10 billion, a 50% decrease over 2019. With that said, high-tech exits increased 55% over 2019 to a record of $15.4 billion. Mostly on account of a significant rise in IPOs in the US. 19 Israeli tech companies went public last year, including Lemonade, JFrog, NanoX, and others. The main sectors for exits last year was computing and software, followed by internet and life sciences. With that said, it is quite costly and time-consuming to go public, and therefore, the reverse SPAC process has shown to be a very attractive alternative for Israeli companies, as Israeli VC firms and private equity firms are looking for cheaper and more efficient ways to take their portfolio companies public. I would just add that what makes the SPAC process so unique is that essentially it's an equity financing transaction, M&A transaction, capital markets transaction, all wrapped into one. We at YA are well equipped to guide Israeli companies through this diverse process, at least with respect to the Israeli legal issues. In the last year or so, we have been involved in some of the largest exit transactions in the local market, such as Intel's acquisitions of Habana Labs and MoveIt, and NVIDIA's acquisition of Mellanox. Just one housekeeping item before we start. Following the talks that we have lined up for today, we would be happy to answer questions from the audience. And to the extent there are any, I suggest that you submit your questions through the chat feature of Zoom and to whom you'd like to address your question. And we'll do our best to accommodate as many questions as possible during the Q&A session at the end. With that said, I'm happy to turn the floor over to my friend and colleague, Ilan Zivotofsky from Moelis.
Thanks a lot, Simon. I really appreciate it. First, I'd like to thank everyone for joining us on the call today. We have a really fantastic turnout, and we have people joining from both Israel and the US and Europe, and really across the spectrum of the investment and corporate community. So thank you to everybody. Next, I'd like to thank Yigal Arnon for partnering on this event. Simon, Shiri, the rest of the Yigal Arnon team. I look forward to working with you in the future on other great events and, of course, on hopefully many successful transactions together. I'd like to take a minute to introduce Moelis & Company as a firm, since I know that for some of you, Moelis is still a relatively new name here in Israel. Moelis is a leading global and independent investment bank that provides innovative strategic advice and solutions to a diverse client base, including corporations, governments, and financial sponsors. The firm was founded in 2007 and completed its IPO in New York in April 2014. Today, we have extensive global network with around 900 employees across 22 geographic locations in the Americas, Europe, and the Middle East, Asia, and Australia, and we have expertise in all major industries. I should also note, because it's very timely and relevant to the Israeli community, we have an extremely robust business in the Middle East, in the Gulf region, where we have a very well-developed and deep office based in Dubai. We opened our office here in Israel about 3 months ago, and we have we're focusing primarily here on M&A advisory, private and public capital solutions, sovereign advisory and privatization, and of course, on all aspects of the SPAC market. We're already seeing significant activity here in Israel. The idea for this webinar was really sparked by a conversation I had with our CEO, Ken Moelis, about the robust SPAC business in the US, and the interest and excitement I was seeing regarding SPACs within the Israeli technology and business community. Yet, based on what I was seeing in the market, it was clear to me that investors, founders, and growth company executives were looking for a better understanding of SPACs. And therefore, I felt like this was a topic of very deep interest, and had a couple of conversations with Simon and some of his partners, and we felt this was a great opportunity to try to help the business community here better understand and hopefully learn a lot about the SPAC product, why it makes sense, and why we think it's a really exciting development here in the US and for Israel. So today we're very fortunate to have with us Ken Moelis, who is the founder, chairman, and chief executive of Moelis & Company. Ken has over 30 years of investment banking experience. Prior to founding Moelis & Company in 2007, he worked at UBS from 2001 to 2007, where he was president of the UBS Investment Bank. Before joining UBS, Mr. Moelis was head of corporate finance at DLJ, where he worked from 1990 through 2000. In addition to running Moelis & Company, Ken serves on the University of Pennsylvania Board of Trustees, Ronald Reagan UCLA Medical Center Board of Advisors, and formerly was the chair and director on the Tourette Association of the American Board. And I'll just say that Ken has obviously incredibly deep experience across all areas of investment banking and capital markets, and is very passionate both about the SPAC business and Israel. So Ken, I'm very honored to turn over the call to you.
Thanks, Elon, and thank you for cutting 10 years out of my life. I'm actually over 40 years now. Somebody's got to update that bio in the industry, so I'm glad you euthanized, you made me a little younger. Well, first of all, it's a pleasure to be here. I've pushed back several trips to Israel for obvious reasons over the last year, and I love coming there, and I look forward to it. I think I'm scheduled in May now. Hopefully, the way things are rolling out, that's maybe possible. I've been a big fan. We've always wanted to be in Israel in a bigger way. Elon gave us that opportunity. I'm excited about it. I had a son and a daughter who both lived in Israel for significant periods of time. And again, very, very excited about it. We've been very prominent in the Middle East, leading the Aramco IPO and several very large transactions. And by the way, the opportunity to be able to fly direct is also another spectacular positive to life if we ever fly again. Let's talk about SPACs for a while. I think Elon did a good job of explaining Moelis & Company, and if you look into it, I think you'll find what we're doing is unique. It's very innovative, and I hope you'll do your own work around that if you need and would like us to help you. Let me start by saying the reason SPACs are misunderstood and have been, I think, having an issue. There are some people who are saying, "What is this SPAC?" Is they're misnomered. Special purpose acquisition company is not actually what they are, and they started with that 10, 15 years ago. And as a banker, I never understood why I would give advice to a client to sell to a SPAC in the early days, because private equity always had more certain capital, strategics, and SPACs always had some contingency in the capitalization. What became clear to me and why we've become so involved in the last 12 months is that they're really special purpose IPO vehicles. That would be the right acronym, SPIV. These are companies that are going public in a new method through a regulatory arbitrage. And what's really happened is there's been no innovation around the IPO process in the United States for decades, really. First of all, I want to be clear on this. I've got a lot of entrepreneurs and VCs and great businessmen on the call today. I love being public, and I want to say that I've met a lot of VCs and a lot of entrepreneurs, and they look at me like I have three heads when I tell them, being public is a spectacular place to be. And I just want to put that out there and make sure I say that, because people treat it, the ability to raise capital in an instant. Literally, if I wanted to raise capital, I could call 3 underwriters tonight and raise almost unlimited capital on the wire overnight. That continuity of capital, that ability to monitor your own valuation on a day-to-day basis and be a buyer or a seller, these things are spectacular helps for your employee base. So I just want to put that out there, because I think there's a whole community who's grown up thinking being public is a negative. And if there are any questions, I'd love to go in that. But let me go back to my IPO. I went public in 2014. And from the day I said, let's go, and remember, I'm a financial firm, and we were ready to go. We were ready to go. I'd say it was 10 or 11 months from start to finish. And during that period, the whole organization, whether you like it or not, is on tenterhooks wondering, how's it going? And you don't know how it's going. You spend 6 months, in the SEC, and literally till you get on the road in the last 2 weeks, you have an idea where you're going. You think you're in a good shape, but it's all conditioned on capital markets coming into the final 24 hours. Literally, I woke up on Monday morning of the final 2 days of the road show, and I see the Russians jumping over. They show the Russians invading the Ukraine. That was the week that they decided. And I'm thinking, does anybody have Putin's phone number? Can he put this off for just a few hours? I got a price. And the market's tanking, of course, that affected, everything got affected, all our planning in the final 24 hours. So what does a SPAC do, or this new vehicle? It cuts about 8 months off of that. It cuts 8 months from beginning to end because of the regulatory arbitrage, meaning, and Alan and Jared are going to walk you through this, but in essence, the IPO, we have already one public called Atlas Crest that a Moelis & Company is done. It's already public. It's trading. It's done, 80%, as I said, you put 80% of the ingredients of the cake in the oven and bake them, and then you hand it to the company that wants to go public for the last 20% for the decoration. But a lot of the process is done in advance. So you cut off a lot of time. Number 2, why is it so attractive today? The public has changed dramatically its valuation of growth. You can see that all over. Growth, the public is willing to value growth, I think, at a significantly higher valuation than even the private market. But when you go public in US security laws, you cannot use projections. And again, I don't want to go into it's litigation. It's the way the underwriting process works. You formally sell your shares to the underwriter, and the underwriter then sells their shares. So nobody wants to use projections because the underwriter retains liability for the accuracy. So it's very difficult. In a SPAC, it's actually a merger. You are merging a company into a pre-existing IPO candidate. Mergers use projections. Almost by definition, in a proxy goes the merged company's projections. So all of a sudden you turn a company that has hyper growth capability, and instead of selling off of the last year's 12 months audits, you have projections. Tremendously changes the ability to tell those stories. And that's why you're seeing so many of what I call the hyper growth companies choose to go via a SPAC. And lastly, certainty. Even in the 3 to 4 months that I've said, you cut 8 months off or 9 months, in the 3-4 months, what you do is you literally go privately and go develop a pipe. And so you actually know who your investors are. And lastly, by the way, you get to curate your own investors privately. Again, when I went public, nothing against Goldman Sachs took me public, Goldman and Morgan. But, I was doing road shows in front of hedge funds, and something told me they weren't for my benefit, that I was somehow paying back due bills for somebody's prime brokerage account. Investors that I wanted to get full allocations got cut back so that better clients would get the first day pop in the price. Again, nothing against those firms, but I didn't get to curate my base quite the way I wanted to. And I knew I was doing a favor for somebody else's capital markets desk. So this is all a spectacular opportunity. And for those, I'm going to turn it over to Alan and Jared to talk about it. But really, I think the best way to think about it for all of you who are doing, and bringing democratization of your different industries, I see this, the best analogy is almost what Twitter did to the news business. So in my world 10 years ago, I watched CNN, I read the New York Times and the Washington Post and the Jerusalem Post, of course. But I got my news feeds, they were dictated to me. And what Twitter allowed me to do, I've never read a newspaper, I don't think, in the last year. I have curated my own news feeds, for better or worse. I might choose the right ones or the wrong ones, but I have a news feed that I curate and I read every day. And it's sort of the democratization. I mean, a brilliant opinion person could get to me now without having the New York Times edit their opinion. I think what the SPAC market is doing is going to create, you're going to get your IPOs through feeds that you like. Right now, there's 200 sponsors out there. Again, like any IPO cycle, I want to be clear, there's going to be spectacular failures and there's going to be spectacular successes. Every IPO cycle goes there. Don't let that fool you. I think the media is going to try to, there'll be a downturn. In 1999, there was an eToys, there was a Pets.com. There were spectacular failures, but there also was, an Amazon and an Apple trading at $1 at the same time. So I think people will start to get their IPO feeds from their own favorite sponsors. And that's a really exciting thing for everybody. And yes, there'll be winners and there's losers. And we want Moelis and Company, again, without a trading floor. The reason we have filed a SPAC is we want to be able to take our companies public through this new asset light, what we think is a superior mechanism in every possible way. And we don't want to, again, the way we're looking at it, just be clear, we did this, we don't want to acquire your company. If you're thinking about going, we have this vehicle, we want to take you public, and we think there's a better way to do it. And this is going to dawn on people that this is not a SPAC, it's a SPIV. And it'll be an exciting time as people go this route. So look, to get into more detail of how it's, and I'll stay on for a Q&A, but Alan and Jared, who are leading this effort for us, I think Alan's going to kind of walk you through how it's happening.
Thanks, Ken. Nice to meet everybody, and appreciate everyone taking the time, in the evening on the 5th for those in Israel. So, we're excited to have this opportunity to present to you guys about the SPAC market in the U.S. and what's going on here. Give me 1 second to just screen share our presentation that we pulled up here, and then we can walk through a few pages that we put together for you guys. Can everyone see my screen?
Yeah, looks good, Alan.
Okay, perfect. See if I can get it into full screen mode. All right, so so as Ken said, and a lot as you said, we've had a fair amount of success in the SPAC market, both on the capital raising side and on the M&A side. Historically, as a firm, we've obviously been very focused as an M&A firm. And so we've done a lot of advisory work for both SPACs and companies looking to do transactions with SPACs. And over the last several months, we've added a number of team members to our capital markets advisory group. And last summer, they joined the firm. focus on both public and private capital markets. And that's an important part of the story here, because as you think about a SPAC deal, what you need to think about is that it's a go public transaction effectuated through a merger. And so it has a lot of elements that are both M&A related and capital markets related. And the PIPE, the private placement that goes concurrently with them, which I'll get into in a minute, has become the most critical component of a lot of these transactions in making sure that the transaction is well received by the market and that you get that deal certainty that Ken was talking about that may not have been there 5 or 6 years ago when people were transacting with SPACs, and what may have caused some of that specialty purpose acquisition company misnomer. That deal certainty has really picked up because of the utilization of a PIPE in a lot of the transactions over the last 3 years. We've been involved in a number of transactions and a number of very large transactions recently, and there are a number more that we've got a few more IPOs on file that we're involved in, as a book runner, and a number of other M&A opportunities that we're in the process of working through that hopefully will be announced in the coming months. So this is our team, and Jared, who's also on the line, and I sort of tackle it from the SPAC M&A and broader SPAC coverage effort. But the way you need to think about how Moelis interacts on the SPAC side is we really view this as a collaborative effort across M&A, and we really have to view this as a collaborative effort across M&A and capital markets. And so a lot of banks will view this as sort of 3 separate transactions for a SPAC. They'll view it as an IPO that's run through their equity capital markets, an M&A deal that's run through their industry group and M&A group, and potentially a back-end private placement where their private capital markets team is brought in on the back end. But where I think we really excel and where we provide differentiated advice to clients across the spectrum is, we integrate our capital markets and our M&A advisory across the entire life of a transaction. And that really allows us to provide a holistic view of how it is that these deals come together and get clients a more efficient outcome, and curate that investor base from an early point in the process, as Ken mentioned. So what is a SPAC? So for those who aren't familiar with the SPAC, a SPAC is a blank check publicly listed company that is formed solely for the purpose of effecting an acquisition or a merger with another company. So what that means is a sponsor like Ken or like someone like someone else goes out into the market and says, what I want to do is I want to go and raise a blind pool of capital that I am going to go and I'm going to try to buy or merge with another company and hand that capital to the other company, either in the form of primary capital going onto the balance sheet for growth, or in some cases secondary capital to pay certain shareholders to exit. They're typically formed by a small group of investors who have either a well-known track record as operators or as investors. It varies across the spectrum on both of those. And they only have a finite life in which to effectuate a transaction. So they only have typically 2 years to do a deal. What that means is from the day that they price their IPO, they're out talking to a lot of targets to try to figure out who it is that their best partner could be in order to try to get a transaction across the finish line that will trade well and be well received by the market. And so when you think about talking to a SPAC as a company looking to go public through a SPAC, it's a little bit different than your typical conversation with a private equity fund potentially, because they can only do one transaction, but they're probably talking to a lot of people. So in a private equity deal, if you're trying to just sell yourself, they might be able to do 3 or 4 deals or more at a time. A SPAC's really looking to do a single transaction, but they're looking to do it in a go public way, and it really can be a very attractive alternative to going public versus an IPO, as Ken said, because it's faster to get to market, you get more deal certainty, and you're able to use projections. So how is a SPAC typically formed? A SPAC is typically formed. There are two different offerings that occur. So the first is the sponsor seeds the vehicle. So the sponsor will put in a certain amount of capital. It's usually between 3 and 5% of the total capital raised, and that capital is at-risk capital. If the sponsor doesn't get a deal done, the people who put the money in get $0 back and lose their money and all the time that they spend on the deal, looking for a transaction and working on it. They typically then will go and purchase warrants in the company, and as part of their risk and their time, it's basically sweat equity for going out and finding the transaction and taking the company public. They will receive an interest in the pro forma company of 20%. And the way to think about that is it's actually a fixed dollar amount. It's not 20% of the pro forma company, it's 20% of the SPAC size they raise. So if they raise a $200 million SPAC, they'll receive $50 million of equity value. And then when they go out and do a deal, if it's $1 billion deal, they'll own about 5% of the company, not 20% of the company. So they own 20% of that pro forma vehicle, including their dilution. Once they've seeded that capital and put the money into the SPAC sponsor, they go out to the public and they offer something called units. And those units consist of common shares, a single common share, and a fractional warrant. And those fractional warrants in today's market typically range from a half a warrant to a third of a warrant per unit, depending on the quality of the sponsor and the size of the vehicle. Some are smaller or lower warrant coverage, so down to a quarter or less. And in some smaller SPACs, you end up with higher warrant coverage. But typically think about it as a half a warrant to a third of a warrant per unit, and they're struck at $11.50. So all of these IPOs are done at $10, just to keep everyone's math simple. And so they're struck up 15%. The key feature of that IPO and why it is that investors like SPACs is the cash that the IPO investors put in go into a trust account that can't be touched by the SPAC until a business combination occurs. And that trust account is invested in US Treasuries and earn a rate of interest. And if the SPAC investors don't like the transaction that is brought to market, they have an option to do something called redeem at the time of the business combination, which allows them to hand their common share back to the company and receive their pro rata share of the cash that's in the trust account. So they basically are earning treasury returns on their cash for 18 to 24 months and receiving upside in the form of a transaction that trades really well because the stock trades really well, and in the value of the warrant that they're purchasing with the unit. And one thing that we've seen in the market lately is historically there were a lot of hedge funds that were investing in these IPOs because they were able to get a lot of leverage through their prime brokerage account, and so they were investing very relatively small dollars of their own actual capital, because the prime broker basically said, look, you're investing in US Treasuries, so I'll give you a lot of debt to purchase this unit, and they were basically getting free warrants. But the IPO investors over the last, call it 12 months, have really shifted to a lot of long-only institutional investors that you want to be long-term shareholders of your company, which also reduces the risk of the closing of the transaction. So the biggest risk in the transaction is actually not the shareholder vote on the merger, it's the redemption. And when you had a bunch of hedge funds that were not going to be long-term holders of the stock, you had to find a way to move that stock from the hedge funds' hands into the long-term investors' hands. And that was typically a process that took a roadshow and a fair amount of work to get done. With the recent changes in IPO investor base, there are actually a lot of those long-only investors that are coming in up front that are just staying in the deal on the back end. So there's less capital that you need to find new holders for at the closing of a transaction, which ultimately means that doing a transaction with a SPAC is less risky than it was even 12 months ago, which was less risky than it was 3 years ago. So all of that has led to what I would say is I think the word boom is probably not even close to sufficient to qualify what happened in 2020. There was over $80 billion of IPO volume in 2020 and 250 SPACs that were raised over the course of the year. If you look back from post-financial crisis, so 2009, 2019, there was only about 45 billion or 50 billion of SPAC IPO capital raised. So the dry powder for SPACs going to take companies public is massive and has been massive for the entirety of the year. And then in addition to that, there are also 81 more that are on file with the SEC publicly. So the way that filings in the US work, they have to file publicly before they can actually go on their roadshow and raise the capital. So in addition to the 250 that have already raised capital, that actually raised capital in 2020, there are 81 more that are in the process of getting approval by the SEC to go out and raise more capital. So another 30% compared to what it is that raised money in 2020. So there's that is to say there's really no sign that this is slowing down and that there's going to be less capital available over the course of 2021. I think, as Ken said, there will be almost certainly some failures in this, as there have been in every single IPO market. People will do deals that are not good deals, and I'm sure that the press will pick those up and have some nasty commentary about them. But at the same time, I think what we're expecting is there will be a stabilization in the market, both in terms of dollars and number of vehicles, and it's going to really zero in on high quality sponsors doing deals with high quality companies over time, and that this is here to stay because of all the advantages that doing a SPAC merger has over doing a traditional IPO in terms of going public, particularly for growth companies. So let's talk about the de-SPAC pipe for a second. So the de-SPAC pipe has become sort of the most critical component of a lot of these transactions, and it serves a variety of purposes. So the first is most SPAC deals today are being done at multiples of the SPAC size. So for a $250 million SPAC, they're not doing a deal for a company that's $250 million. They're typically doing a deal for a company that's between $1 billion and $1.5 billion. So somewhere between, call it 4 and 6 times the size of their vehicle. Some of those companies need more than $250 million in capital. And so a PIPE, which is a private placement into the public company, will allow the SPAC to do deals that require more cash than they have in their trust account. So if you needed $500 million of cash in order to effectuate your transaction, a $250 million SPAC could go out and raise a $250 million PIPE, and they would have $500 million of cash to bring to a deal. The second is, if you think that there may be investor redemptions and there's an actual minimum amount of cash you need to close the deal. So let's say you were a $250 million vehicle and the company needed $200 million, but could stand to have up to $500 million to fund their growth plan. You could go out and raise that PIPE, and the PIPE is truly committed capital, unlike the trust account. And there's really, once they've signed their commitment agreements, there's really no outs. So PIPE investors are locked up as soon as they sign it, and you typically raise your PIPE and sign those commitments before you announce the transaction publicly. So it's done in private before you announce the deal and before you actually go and market it to the public investors. So you can have that certainty of funds to make sure that you're going to get the cash that you need before you ever go out to the market to solicit the existing public investors. And then the third reason, and this is really where it started and where it's become the most critical component, is it does allow the company on a private basis before they launch their transaction publicly to go through price discovery. So all of the discussions that happen in a PIPE happen, as I said, on a private basis, and they happen with key fundamental investors. And you're typically looking to bring in people like the people at the bottom of the page that are long-term investors that you want in the stock, that are viewed by the market as really intelligent investors. So guys like Fidelity, guys like Wellington, guys like T. Rowe, people that when they're in a stock, the stock just has that cachet that it has the right set of long-term investors in the base. And because they're doing it on a bit of a longer basis than a traditional IPO, they have time to do diligence and do some more work around it. And so they can validate the pricing of the deal and the deal terms before you ever launch the deal publicly. Unlike in a traditional IPO where all of that pricing mechanism and validation occurs while you're out in the market with a price bogey. And so the company has the ability to go through and have those discussions and really talk to the investors and talk to the investors to figure out how it is that the deal is going to be received by the market. At the end of the day, what that ultimately means is you can choose to accept the pricing terms of the PIPE or not and go back to being a private company without ever having that public taint that you would have if you went through a traditional IPO. I don't think we need to spend a lot of time on this page. Ken covered most of this in his introduction, but the difference between the SPAC combination and the traditional IPO, the biggest differences are that private price discovery, the speed to market, because you actually do shave anywhere from sort of 5 to 8 months off of the IPO timeline by doing a SPAC merger, because it's effectuated as a merger, not as an IPO, and the ability to use projections, which for growth companies can help support higher valuations than you might be able to using only backwards looking information. This is just some recent successful, de-SPAC transactions. So I'm sure a few of these are names that you know, guys like Virgin Galactic and DraftKings. Both had very successful de-SPACs and have traded up substantially. So if you just look at their returns compared to the market, DraftKings, from the time that the SPAC that they merged with IPO'd to today, the market's up about 30%, whereas DraftKings is up, whereas the stock that an IPO shareholder would have bought is up 370%. So there's obviously been a number of very successful deals, which explains why there's a lot of capital coming into the market looking for IPOs. So what makes an attractive SPAC candidate? One thing that I think people need to think about when they think about doing a, excuse me for 1 second. Sorry. One thing that people need to think about when they think about a SPAC merger is it's not a sale. And so where people get, I think, caught up in these deals is where these deals go wrong is where a company that's looking to go public through a SPAC tries to maximize their value on the day that they merge with the SPAC. Because really what's happening is they're going public and they're going to be long-term holders of the stock. And so what you want is a stock that trades well right after announcement and right after the deal closes, all the way through the near to medium term, and obviously into the long term. And so you want to make sure that you're pricing the deal in a way that causes that stock pop and therefore trading momentum to keep the stock going in a positive direction. If you try to maximize value and price to the very top of your comp range, what you typically see is deals that will go out into the market. They might get done at that range, and they trade down immediately after, and you end up in a position where it's very hard. Once you trade below the trust level, it's very hard to recover from that without meaningful changes to the business plan. And so you need to think through how it is that you're pricing the deal compared to the comps, similar to the way that you would think about pricing an IPO, as far as making sure that there's room for investors and you to make money, but you want to make sure that there's positive momentum. So you should think about it as an IPO, not as a sale. And then, as Ken said, the market is paying for growth right now. And so, but they're only paying for growth where they can see a path to it. So there are two ways to do that, right? There are a lot of companies that are trading really well because they've got massive addressable markets and they only need to capture a very small amount of it in order to be worth large dollar amounts. And then there are others where it's a little bit more blocking and tackling and being able to tell a very clear story about how being public and having the capital on their balance sheet is going to get them from being a very good growth company to a very, very good growth company in the near and immediate term. And so you have to think through how it is that being a public company and having the capital that's coming on your balance sheet can really define your growth story. And frankly, M&A is something that people are willing to pay for as well. The fact that you have a public currency will allow you to execute an M&A angle will be well received by the market. And then, so the last place we'll wrap up, and then we can turn it over to others to follow up, is just on some of the key areas that people spend a lot of time on negotiating in the merger agreement. And we're happy to do follow-up calls with people as they're thinking through potential transactions. But the key areas to think about, right? Consideration. So whether you're taking cash or stock and how much of each you're taking. It's harder to take more cash and achieve premium valuations. So it's one consideration as you think through it if you're taking cash off the table. And earnouts are quite common in this space, including share price hurdles. So people are taking a lot of earnouts in the form of share price performance in the SPAC context today. Sponsor consideration. I mean, sponsors are not typically giving up their shares in the current market. Sometimes what you're seeing is if they want to do a deal that's on the smaller side of their size range, they'll do something called tiering. So instead of taking all of their shares on day one, they'll take half of them on day one and half of them if the stock trades up to $12.50. But it's a structuring consideration that you just need to think through depending on the relative size of the sponsor promote compared to the overall equity value of the company. And then the biggest one on the deal certainty side is the minimum cash condition, and this is really one that it's a little bit perverse. So if you think about the minimum cash condition as the amount of cash the SPAC has to deliver at closing in order for you to have to close, you might think, oh, if I need $400 million of cash, I should set the minimum cash condition at $400 million. What's interesting is the higher the minimum cash condition, the more likely redemptions are. The lower the minimum cash condition, the less likely redemptions are. And that's largely because what people see is the stock will trade up if there's certainty that the deal will close, because people don't hang on for that option value on the redemption. They'll just trade out of the stock and allow the fundamental investors to come in. And so it's a balancing act between making sure you're getting enough cash in the deal that you feel comfortable doing the deal at the terms that you're agreeing, but not overstating your minimum cash condition to put the deal at risk that, a small number of redemptions, potentially causes a cascading effect of redemptions such that you end up with much less cash. There's one more page with some, seller lockups, governance, and exclusivity, which I think are all things that we can just talk about at the time of a potential transaction. But I think that's pretty much what the market is looking like right now. And why don't I turn it back over to Alon just for any closing remarks on the Moelis side before turning it over to others.
Thanks a lot, Alan. And that actually, I think I'm going to turn it over, I believe, over to Adrian, Eagle Arnone, to kind of take it away and speak a little bit about the legal side of SPACs and IPOs.
Sure. Thanks, Alan. Let me just try to share my screen for a second. Great. Do you all see my my slide, legal ramifications? I'll take that as a yes. Great.
We can see it.
Okay. So I'll try and keep my segment as short as I can. I don't want it to be seen as the opposite of what Alan was saying. You know, this is in no way supposed to scare people off doing SPACs, but I think it's important that people understand, you know, what awaits you on the other side of a SPAC transaction, because there will be major legal, financial, and practical consequences of doing a SPAC transaction. Now, following a SPAC transaction, you're going to be a publicly traded company in the US. You'll be subject to US and probably Israeli laws and regulations. Now, I say Israeli laws and regulations as well, because I think the trend with Israeli companies doing SPAC transactions, and we saw this with Innowiz, is going to be that the Israeli company itself will become the publicly traded company, with the old SPAC entity becoming an empty sub underneath. There's no requirement for this, but I think the benefits of doing it this way outweigh the disadvantages from practical, tax, and legal perspectives. So assuming that this is the case, once you become public in the US, you are likely to become what is confusingly referred to as a foreign private issuer. Don't be confused by the word private here. It doesn't mean you're a private company still. It just means that you're not a foreign state or a foreign government. You're still a publicly traded company, but being a foreign private issuer means that you can enjoy a number of exemptions from the requirements applicable to US companies. Having said that, before I go further down that road, I just want to give an important caveat that's vital that you bear in mind. It is possible that while you are an Israeli company, you will actually not be deemed a foreign private issuer that is eligible for certain exemptions to US regulations, but you will be deemed a domestic US issuer, subject to all the US requirements. Now, this will happen if 50% of your voting shares are held by US residents, and a majority of your directors and officers are US citizens, or a majority of your assets are in the US, or your business is principally in the US. Now, there are ways for calculating each of these, and you'll need to take advice depending on your particular circumstances. But the point that I'm trying to make is that assuming that you prefer being an Israeli company that's traded in the US, in other words, a foreign private issuer, you should, during the process, structure the deal to make sure that you don't accidentally, at the end of it, become a US domestic issuer, despite all your attempts otherwise. So that is something that you should always bear in mind. So I'm gonna touch on a few issues that you will need to be aware of when becoming public. In this discussion, there are 6 things I'm going to touch on: disclosure, corporate governance, investor registration rights, timing, liability, and costs. So I'll take the first of those. So dealing with disclosure, while as a private company you could sort of talk to whoever you wanted to, whenever you wanted to talk to them, and you could go looking for investors and even engage finders to look for investors. As a public company or a company publicly traded in the US, the scope of what you can say and when you can say it and to whom you can say it is heavily regulated. Just for instance, anything you say to an investor must be disclosed to the public in a public filing. Any forecasts that you make will need to be heavily qualified. Disclosures about facts and figures must be accurate, and you can't omit information which, if disclosed, would obviously have an impact on the facts and figures that you're disclosing. And obviously, your ability to trade your company's shares cannot be done when you are in possession of material non-public information. So for instance, around the time you're preparing financials or prior to material press releases, you will be in what's called a blackout period, and you will not be able to trade your shares. So you do need to be aware of these differences. In terms of the actual the principal disclosure documents, they are, for these purposes, and I don't want to go into the disclosure documents that you will need to provide when doing future offerings. But just in general, the two principal disclosure documents that you will need to be aware of are the Form 20F, which is the annual report, and the Form 6K, which is a current report. As far as 20Fs go, this is an annual report that needs to be filed by the end of April every year. It's a mini prospectus. Well, it looks like a mini prospectus at least, although when I say mini, it's still going to be probably more than 100 pages long. And it will be filed together with your annual financials for the previous year. In other words, the year immediately prior to the April in which you file your 20F. And you'll need to also include 2 to 3 years of financial information at least, all of which will need to be based on US GAAP or IFRS standards. I'm assuming that itself is not going to be a problem, because you'll have to convert your financials into one of those for the purposes of the SPAC transaction itself. But it is something that if you're looking to do those sorts of transactions, you will need to be thinking about how you're going to be presenting and calculating your financials. Now, the 20F is likely to share many of the elements that were included in the F4, which was probably filed as part of the SPAC transaction. But you're going to need to update everything other than the financials themselves to the most reasonable practicable date prior to the filing itself. Now that means, for your purposes, that you're going to have a CFO who is very well organized. He or she has all the figures at their fingertips, and is able to access and be completely appraised of everything that's going on in the company. Additionally, excuse me, the 20F is going to contain attestations by the CFO and the CEO of the company on the company's internal controls over financial reporting and internal controls over disclosures. And I'll say a word about that in a second. But the requirements themselves were created in the wake of the Enron scandal. And the aim of them was to ensure, this was the early 2000s, and it's to ensure that the financials of publicly traded companies are not misrepresented, that information isn't hidden, and that effective measures have been put in place in a company to ensure the upflow of information from the lower levels of the company all the way through to officers. Now, these controls are expensive to put in place. You'll probably end up doing them together with your auditors, and you need to it's a full-blown task that the company, the CFO, and management will need to be deeply involved in. And it's going to require auditor sign-off when it comes to the annual report. And in the 20F, as I said, the CFO and the CEO will each need to attest that they've personally evaluated these internal controls and they've ensured they're effective. And if they aren't effective, they're going to have to explain what the weaknesses themselves were. And there's personal liability on the officers in respect to those attestations. I'm not going to go into more details with respect to the 20F. It may just be interesting to note that nowadays, because of changes in reporting requirements in Israel, the top 5 compensated officers in the company will have to disclose their compensation in a 20F as well. That didn't used to be the case, but it is now. Current reports on Form 6K. There's no actual law relating to what must be filed on a 6K. But basically, whatever you would have to file in your home country, in other words, in Israel for Israeli companies, on your public market, there would need to be in a 6K. So you'll need to file a 6K for any material events, and certainly for any major disclosures that you need to make with your shareholders. And it's important that a company gets good IR advisors for how best to draft and put across many of your business disclosures. So moving on to, I'm doing this very rapidly and very generally. Obviously, this is not formal legal advice, and everything that I'm saying has exceptions and far more layers of depth to it that I'm giving. This is very much an overview. But again, the corporate governance is very different from what you've become used to as private companies. And things can get quite complicated here, because while you're traded in the US as an Israeli company, Israeli law still governs many aspects of how the company is run. While you're traded in the US law applies to many aspects as well. So you've got the US law applying on the one hand, Israeli law applying on the other. In some cases, those laws overlap, and they can even conflict with each other. Now, generally speaking, in order to deal with this situation, Israeli law provides for certain exemptions from certain of its legal requirements for companies traded in the US. And in some cases, the US law provides for exemptions from certain of its legal requirements for foreign private issuers. So you're going to need to keep an eye on both sets of laws and try to navigate what's applicable and what is not. Now, I'm not going to get into the weeds too much, as I said, but in terms of a general overview, there's a few aspects, as you can see here, that I wanted to talk about in terms of corporate governance. Israeli companies, unless they get exemptions, or entitled to exemptions, have to have dachatzim, in other words, external directors. Those are directors who are basically independent of the company, its officers, and any controlling shareholders. But even if you have an exemption on the US requirements to have external directors, the US still requires that the majority of your board needs to be independent. So I raise this because it's probably worthwhile early on in the SPAC process that companies start to think about who is going to populate their board, and particularly in light of what I said at the beginning, which is if you don't want your company to be considered a US domestic issuer, those people that you want to have on your board probably should be non-US residents, as well as fulfilling all of the various requirements, either as dachatzim or as independent directors under US requirements. Now, just as a little side, when I say US requirements here, these US requirements may be US statute, or it may be the rules and regulations of the market on which the US company, the public company is traded. When you're a public company, both under Israeli and US law, you're going to have an audit committee and a compensation committee. The audit committee is there to supervise the preparation of financials and the work of the auditors. And the principal role of the compensation committee is to recommend to the board compensation for the company's officers, directors. The laws regarding the composition of each of those committees are under Israeli law, unless, of course, you have an exemption. Another important aspect to realize in terms of corporate governance is the company is required to have a compensation policy. There's no opt-out for this, there's no exemption for this. And that policy, which determines the mechanism for how compensation for executives is calculated, will include, for instance, specific provisions for the mix of elements of compensation, which must be fixed and which can be variable, for instance, according to results, as well as requiring caps or ranges on the level of compensation that can be paid to executives. And this policy has to be presented to the shareholders every 3 years and approved by a special majority of them. Now, there are ways of getting around the limitations of a compensation policy. I'm not going to get into that right now, but it never looks great for a company to go beyond what has been permitted in its compensation policy. And the last thing I just want to talk about in terms of corporate governance is interested party transactions. That is transactions in which directors, officers, or controlling shareholders have an interest. So these sorts of transactions must be brought to shareholders for approval. Now, while this is the case to some degree with private companies in Israel, what's different when you're public is that, well, first of all, you don't know all of your shareholders, obviously. And second of all, certain of those transactions will actually require special majorities of disinterested shareholders. So while you may have been able to push certain decisions through your shareholders relatively easily when you're a private company, it's not going to be quite so simple when you're a public company. I want to end with 5 short comments about certain other things. I'm going to talk about registration rights, timing, liability, and costs here, which I think also are areas that need to be borne in mind when considering a transaction where the final result is that you're going public. In respect of registration rights, if you're an investor in a SPAC, the transaction is unlikely to come within the definition of an IPO, which would trigger those rights. And plus, because of the pipe element that we've heard about, you're likely going to have to renegotiate your ability to exit the company. I say because of the pipe element, that's because those investors themselves will have registration rights. So as a result, you may have to renegotiate your ability to exit the company. Now, this is less important if you are not an affiliate following the transaction. What does being an affiliate mean? An affiliate, you are deemed to be an affiliate unless you can show otherwise, if you hold more than 10% of the shares of the company, or if you hold a directorship or otherwise can control the direction and decisions of the company. So if you are an affiliate, then how you are going to be able to sell your shares in the future is going to be important, because you are going to be subject to certain limitations as an affiliate of a publicly traded company. If you're not an affiliate of the company, then the chances are that after the traditional probably 180-day lockup period, you will be free to resell your shares without registration. But in any event, this is something as an investor, when you are going through the SPAC process, that you'll need to be mindful of. A couple of last things. So timing, things take longer and or they have more moving parts when you're a publicly traded company. Notices to shareholders are required to contain certain information, and notice periods are longer. You're going to have to work with the transfer agent with respect to issuances and even transfers of shares. And even to sell shares, even if they're not locked up or restricted in any way, you may still be required to coordinate opinions and complete other paperwork in order to help your shareholders transfer their shares. Liability, obviously you're going to have much greater liability as a publicly traded company. Your target audience is the public. The public holds your shares, which means the number of people who may suffer damage as a result of your action or inaction or omission is much greater. And that's going to have an impact, among other things, on your insurance premiums and among other things. And obviously there are criminal sanctions which can be imposed by the SEC on you. And the last thing, obviously, just to sort of sum all of this up, is costs. The costs of going public, or rather the post-going public costs of a company, continue to be high. So whether it's Edgarizing disclosure documents or printing proxy statements for shareholders, or working with engaging and working with a transfer agent, the costs associated with legal, with lawyers and auditors, which are associated with all the additional areas that need to be dealt with as a publicly traded company, all of those will involve significant costs. So again, being a public company is an expensive business, and you have to be aware of all of that. Obviously, none of this is to take away from the advantages that the access to the markets and investors described earlier will give you. But the principal reason for saying what I'm saying is that these are all issues that you will need to be aware of when taking that decision to enter into a SPAC transaction with the final result of going public. Thanks very much. I'll pass the baton over to my partner, Nimrod, Nimrod Vroman, who is sitting in the little window with the name Simon Weintraub under him.
Exactly. Yeah, I just went to see where Simon's sitting, and I'll be speaking from here. Thanks, Adrian, for that. I'm aware of the fact that we're past schedule, so I promise to keep this only 3 minutes. Speak a little bit about the business case of going public for startups. I'm a partner at Yigal Arnon in the high-tech department, but I'm actually speaking on behalf of a new consulting firm that we've incorporated and I manage together with Yigal Arnon. This consulting firm is called Conciliary, and our focus is to help startups and help startup executives with non-recurring strategic transactions, which means transactions that the startups go through in their life cycle between 1 and 3 or 4 times. We come in there and we handhold management throughout and help them in these processes and bring them to an optimal result, including managing all of the service providers involved in the transaction, including legal, finance, IP, etc. And we've actually launched 6 months ago, and we're really looking forward to making big impact on the Israeli tech ecosystem, because there aren't many competing services with what we're offering at the moment. I just want the remaining attendees to have 3 takeaways about the process and about the implications of the process on the business level. One is stakeholder management. These transactions, the SPAC may simplify the US side of going public, but the company on the Israeli side will still have to deal with the complexities of what is essentially a deemed liquidation or an exit event or a transaction that is meaningful in the company's life cycle and that will require special approvals. In my experience working with executives and founders and controlling shareholders, at times they expect that these transactions will be approved to the extent that they've lobbied for the requisite majorities to approve the deal, like 50% of all stock and whoever owns the veto rights. But in reality, when you're working on a tight timeline and you want to benefit from what the folks at Moelis can do for you and the speed at which you can close the SPAC transaction, if you want to benefit from that, you have to manage your stakeholders on the Israeli side. And at times, it would be better, it would be prudent of you to be able to have a unanimous consent to the transaction going forward at board and shareholder level, depending on the age of your company and how many shareholders you have. So communicating with your stakeholders well in advance of the transaction, explaining to them, getting your consultants to explain to them what's going to happen and when, will avoid losing out on the benefits that the SPAC transaction gives you compared with other public offerings. That's one. So stakeholder management, do it right. Secondly, a lot of the Israeli companies that will consider this process will not by that time have placed the executives in the operational and financial positions in the company that you would normally see in a mature company. You won't have both a CFO, a COO, and a GC in these companies. And if you haven't populated these positions before the transaction, it might be wise to look into that or to have someone filling in on those roles. Otherwise, the transaction will might become a managerial burden, and you won't have someone organizing all of the information and the process for you on the inside. Moreover, after the transaction is done, you're a public company and you're subject to a lot of the regulations and rules that Adrian mentioned, and you got to operate with these people on board and inside the company. And the third takeaway, the final takeaway, is that up until the moment where you're publicly traded, your business plan, normally startups have this business plan that talks about achieving certain goals, business product, sales milestones every 2 years, 6 months before the runway, 6 months before the money runs out, in order to be able to raise the next round of financing at a higher valuation, et cetera, et cetera. And those goals sometimes they fit what VCs or what growth venture capitalists or what PEs expect to see in startup companies. So when you're shifting and you're looking at the SPAC, you want to have a business plan, as Alan mentioned earlier, that will satisfy the public and what they expect to see in terms of growth. What's important for them, and you can obviously consult about that and adapt your business plan and your budget, your expected budget accordingly. So those are the three things for me. I think I was within the time frame, and we've got 2 or 3 Q&As that Simon will lead on our behalf. So he's going to take the screen and his name back. Thanks, everyone.
Back here. Thank you, Nimrod. I apologize for the late hour. I know it's really kind of late, and we've received a number of questions. I'm going to ask 2 of the questions right now. I'll read them out, and then I guess actually these questions probably are probably more relevant, Elon, for you and your team. And I'm going to ask 2 different questions. I'll try to combine them as one, but if you guys can maybe give us some insight. One question we received is, in the past, reverse mergers by shell companies and pipe deals took a lot of heat. How are SPACs different? And the other question one of the other questions we received is, what level of interest is there among sponsors from medical device companies? And if any, what stage do these medical companies have to achieve in order to be suitable for a SPAC?
You want me to try to take that, Elon? Yeah, you're on mute. But look, just on the first, I think the reverse merger, just to cover that, I think the pipe investor now is covering a lot of that, meaning in the old days when you had a reverse merger, there was no confirmation of value. The fact that the pipes are marketed and confirmation of value is changing very much the idea of reverse mergers into companies with no due diligence and no pricing mechanism. So I think that's changing the world a lot. And the last part, yeah, medical devices, healthcare is a phenomenal part of growth companies. We're seeing enormous interest in that. And again, I can't tell you look, there are companies out there with, double-digit revenues with billion-dollar valuation, depending on what the science is, what your protected technology is, what the TAM is. I think those are things better left to discussing. But this new market, I would say, I just looking at some of the companies, a lot of the EV companies, there's a lot of battery technology companies that are 3 to 4 years away from revenue. Yeah. So don't, if you've got the right product with the right projection with it's got to be, you got to have a pretty good story out there. But I've said, I think these are going earlier than we ever would have imagined.
To your point, Ken, a lot of it's about the TAM, right? Being able to demonstrate that addressable market.
And just one other thing specifically on medical devices, there are a number of smaller SPACs, call it in the $50 to $100 million range, that are focused exclusively on either biopharma or biotech in the US. And we've seen a few deals that have been done in those sectors for companies that are, even at that sort of, in the US, it would be sort of phase 2 FDA approval level, which is much earlier than I think you've ever seen IPOs historically for companies going through the FDA approval process in the US, still getting funded. But, oftentimes those, when they're going through diligence, they're hyper-focused on how good the data is and whether or not there's conviction around getting through phase 3 and to commercialization. And obviously there's that big step up in valuation once you do that in that sector. So for that sector specifically, there's been a small group of high quality investors in the space that have formed SPACs specifically to invest in early stage companies in those sectors. So, if that's something that you're interested in looking at, we're happy to have a conversation about it.
All right. Well, thanks everyone. I think it's pretty late right now. I just wanted to thank obviously all of our speakers. Thank you, Elon. Thank you, Ken, very much for being here, as well as Jared and Alan. Thank you, Nimrod and Adrian for speaking. We plan on sending a webinar summary after the event. Anyways, we're here at YA, and certainly the folks from Moelis are here with Elon on the ground. So feel free to be in touch. Happy to answer any questions. Sorry for any questions we didn't get to answer today. I'm kind of hoping that in a year from now, we can do a similar event, but we'll structure it a little differently. Hopefully we'll have a bunch of founders in Israel who have already been through this process, and they can talk about their experiences. So something to hopefully look forward to next year. So thanks for your time, everyone, and have a great evening.
Thank you.
Thanks a lot.